free. Now,
this is the Gold Newsletter Podcast, your home for investment, economics, and geopolitics. For our publications and archives, go to goldnewsletter.com. Welcome to the Gold Newsletter Podcast. Fergus Hodgson, your host here. We have a repeat guest, Rick Rule. He is a longtime friend of both the conference and Gold Newsletter. Brian London is also on the line. Rick Rule is the CEO of Sprott U.S. Holdings Incorporated. He began his career in securities in 1974, and he is a leading American broker specializing in mining, energy, water utilities, forest products, and agriculture. And his company has built a national reputation for taking advantage of global opportunities in these sectors. He has a thrice weekly e-letter, Sprott's Thoughts. Now, Rick, thanks for coming back. And does anything need to be updated in that bio?
No, that's pretty thorough. It's more thorough than I would have written myself. So, thank you.
Excellent. And last time we discussed, I guess, just your broader philosophy of your work and how you understand the markets, and particularly maybe group dynamics. And today we'd like to drill in a little bit more into specifics. And so I've got two articles here. One is on copper and the other on uranium. And these are maybe new topics to the listenership or to the audience here. So why don't you explain why these two items have garnered your attention of late?
Happily. First of all, they've garnered my attention because they haven't garnered very many other people's attention. I like to be in a sector before the mob moves into them. They've also garnered my attention because of my belief that both are essential ingredients for the future of mankind. Uranium in terms of generating the stuff of life, electricity, and copper for distributing the same. And the third reason is that they both sell for less than the global cost to produce them, meaning that the industry is in liquidation. And the longer that situation goes on, the more immediate the shock of supply shortfalls are. In both circumstances, copper and uranium, the selling price of the commodity on a global basis is less than the total cost of production. And those circumstances are attractive to me. So I'm attracted to both substances for the same reason. It should be mentioned in passing that copper has built more fortunes in the mining business, substantially more fortunes in the mining business than gold. It's a broad market. It's the type of mineral that leads itself to large deposits that produce over years and, in fact, produce over decades. And with regards to uranium, and Brian can attest to this because he was in the last bull market, the last uranium bull market was probably the most profound speculative event of my career. Heading into the last bull market, there were 4 or 5 remaining uranium juniors. We tried to own them all. I made the best stock pick of my career from the podium in New Orleans, recommending Paladin uranium at 10 cents, and watched it go to $10 from 10 cents. But the truth is that the basket of 5 uranium juniors, if my memory serves me well, moved so dramatically that the worst performer of the lot was up 22-1 over 6 years. So I'm attracted to these metals, both of these metals, for a variety of reasons. But as you can tell, I'm very attracted to both.
and boy, that uranium story, Rick, surely was something, and I think it will be again. You know, adding to your bio that Fergus recited earlier, I would add to that by saying that you're the best or most successful speculator in the junior mining class or sector. And the reason why you are is because you have the deepest understanding, I think, on a cellular level of the cyclicality of these markets. And even beyond that, you have the courage to invest at the bottom of the markets, which is crucial. absolutely crucial to be able to buy when no one else wants to. And the uranium market is one of those areas where you did that. I mean, you were the original uranium bug, despite any other people who came later and tried to claim that title. You were earliest on there. You actually built companies that went out, much as we did with Silver Standard, that went out and bought out of the money uranium assets. And some of these companies split into more and more companies. I mean, at the top of that uranium mania, there were about 500 or so uranium junior companies out there, weren't there?
That's right. From a start of 5 companies when the price of uranium had to go higher, to a peak of 500 uranium companies when the price had to go lower. There's an instructive lesson there, too. Mm-hmm. When the wisdom in a trade is obvious, the trade is over.
Right. That's exactly right. And from those 500 or something companies, there's now, I would guess, about 10 or so that are really worthy of investor attention. And if we do have that kind of mania, these again, which I think is inevitable at some point, that in all the investor attention, at least initially, will be focused on 10 or so companies. So the reaction, the response is going to be outsized in that case. And of course, there'll be a bunch of companies that will suddenly sprout like mushrooms after a rainstorm. But those 10 companies, I think if an investor has patience, finding a basket of 4 or 5 of those will pay off over the next few years quite handsomely.
Well, you said a bunch of interesting things there, Brian, which need commenting on. The first is that patience will be required. Mm-hmm. Just because the commodity is selling for less than the cost of production doesn't mean that the price will go up, a lesson that I learned in the last bull market. The truth is I was 4 years early on the uranium trade, and that tested not my patience so much, because I've done it before, but the patience of clients and investors. And I joke that if you're 4 years early to 10% discount, you aren't early, you're wrong. The truth is that the stocks performed so well that they overcame any time value of money rent I had to pay on them. But your subscribers need to prepare themselves for a long, rocky road. Your second point is interesting, too. We are back now to where we were then, in the sense that the 500 pretenders in the space have given way to, and I think your guess is right, about 10 contenders as opposed to pretenders. Mm-hmm. And if past is prologue, when the market moves, the 10 who are already in place will greatly outpace the new crop of pretenders. What really excites me about the uranium space, though, Brian, is that there is a generation of speculators in place who participated at least vicariously in the last uranium bull market, have a memory of it, and would like to jump on again. You will remember the first couple months of this year when the uranium stocks basically tripled.
Right.
On no volume. It says something about the fact that and that was a false start, of course,
yeah,
that when the space gets a little tiny bit of momentum, the greed inherent in speculative markets, fueled by the experience that people had in the last run, really drives people into these little stocks.
Yeah, and that was on the basis of only about a 10 or 15% blip in the uranium price. So these things are really primed to move, and the fact is that all of the companies now are either, the good companies, the vast majority of them, I would say, are either in production or on the verge of production, so their response to higher uranium prices is not only emotional, but actually on the bottom line.
I think that's right. Now, it's worth noting that people who get involved in that trade now have to be prepared to participate in at least one more financing for the whole round of these companies to make sure that they stay alive until the bull market starts. The bad news about being in production or having the ability to be in production is that means that you have the ability currently to lose $20 a pound, which is damning them by faint praise, certainly.
Right.
But having, as an example, the ability to produce 2 million pounds a year, even if you're not producing 2 million pounds a year, the fact that you don't have to spend the startup capital and you don't have to permit means that you are really primed to go higher without the lag time often associated with commodities bull markets.
Right, right. And talking about lag time, you had mentioned that you like copper and have liked copper, but you're getting a lot of company in that trade very quickly. Copper just over the past month has really made a surge to the upside, and it's now becoming more of a mainstream story. And your point that copper has created more wealth in the mining sector than anything else is well-founded. Big moves in copper create wealth that then gets plowed back into the sector, and it's also commingled usually with gold. So that's a good sign, I think, for gold bugs and anyone in the resource sector.
Well, I think that's right. Very often, copper-dominant deposits have good gold credits, and in the process of exploring for copper or gold in tertiary volcanic terrains, where you're looking for epithermal gold deposits or porphyry coppers, one tends to go with the other. The big porphyries, certainly, while being gigantic copper producers, also produce formidable amounts of gold. And so often you get one with the other. But it's important to note that the free cash flow generated in good copper markets from copper mines dwarfs the free cash flow associated with gold production or free gold production. And ultimately, the business is about more than leverage to commodity prices and more than a political point of view associated with gold ownership. It's about generating free cash flow from mining, which copper does really, really well.
You know, we touched on the cyclical nature of the markets, and of course we also touched on uranium and copper, but for the broader markets, and I guess really gold, because everything flows from gold, that's what really sparks a bull market or the excitement in the junior resource sector. My opinion is that we bottomed in December of 2015 in the gold market, and of course we had that drop in the latter half of last year, but we're on the upswing again, and I think this market, this junior market, is just rife with opportunities. But nobody knows, as I said, the cycles or understands them better than you. So I'm very curious to hear what your opinion is of where we are in the cycle.
Well, I agree with you completely. I agree that we bottomed in the gold metal and the gold stocks concurrently in 2015. We had a tremendous run in the junior gold stocks in 2016, really a tremendous run that was due to a resumption in buying interest, but more particularly it was due to sellers' exhaustion. All the people that had to sell had sold, so we ran out of sellers. Interestingly, in 2016 and 2017, gold did fairly well, and importantly, it did well concurrently with U.S. dollar strength, which has happened only twice before in my career, in 1975 and in 2001. Gold move concurrent with the dollar move can be very important if the dollar rolls over, which it looks like it may be doing. Not a forecast, by the way. Better yet, from my point of view, the gold stocks gave back a lot of their gains. Of course, they had to give up a gain that was as dramatic as the gain that occurred in 2016. But we have a situation now that's very healthy, with the commodity leading the stocks and with a healthy degree of skepticism with regards to the stocks. These are, from my point of view, the optimal conditions to be a speculator, because you're not competing with the dumb money. Meanwhile, there is an awful lot of capital available to the industry, but mercifully right now the capital is fairly selective. If you go to market with a good product, good people, a good deposit, the capital's freely available. If you go to the market with dross, the capital isn't available, so we're in a really healthy space. And finally, I think it's important to note that we are really, truly back in an exploration market. We're back in a discovery market. Good drill holes, not just splashy drill holes, but good drill holes are meeting with buying interest. And finally, after 20 years, some of the better investors in the world are employing good technical help on their staffs so that they have the ability to differentiate between good drill holes and splashy drill holes. So I see a really healthy market. I see a decent commodity price. I see the equities lagging the commodity. I see the availability of capital, and I see the capital being smarter than it's been for the last 20 years. This, to me, is the hallmark of a very healthy market.
You know, I agree with you on all those points, Rick. And in fact, I've been recommending and really pushing in Gold Newsletter exploration plays because I suddenly realized this spring that there was a lot of companies out there that had spent 2016 recapitalizing, filling the coffers, and getting back to work on some high-profile, high-potential projects around the world, but largely in the Northern Hemisphere, and on projects that had essentially lain fallow for over 4 years since the last peak in the cycle. And now, this summer, this drilling season, it seems like there were at least a half dozen or so that I identified in Gold Newsletter, companies that were starting to drill these targets and were set to deliver really good news, or had the potential to deliver really good news to the market. So far, it's worked out pretty well with a few nice discoveries and good results and more coming in. And so I think that's going to be a real theme going forward. As you know, discoveries feed the market. They create wealth that goes back into the market. And that's what really gets the excitement, kind of sparks rallies.
Well, what you say is very perceptive, and you need to add to that the fact that there has been a dearth of exploration expenditure for the last 20 years.
Right.
The major mining companies and even the intermediate mining companies have fairly skinny development pipelines. The consequence of that is that a good discovery, even a fair discovery, commands fairly strong multiples. As an example, the Integra takeover not too long ago speaks to what happens when you deliver up a good project to a project-starved market. I believe you're having Brent Cook speak for you in the New Orleans conference this year. And right. Brent has done, I think, a very, very good job. I'll be looking forward to hearing him in New Orleans talk about his thesis with regards to exploration success and the need that major mining companies have to fill up their development pipelines with new discoveries made by juniors. It's also important to note that the structure of the industry with regards to exploration has changed, and increasingly the juniors are sort of fulfilling the function as the outsourced exploration departments of majors, recognized by the fact that majors buy the successful juniors, but also because the majors themselves are becoming substantial sources of equity capital for juniors in the market, replacing generalist investors, which I think is another very healthy sign.
Mm-hmm. Yeah, and you bring up, well, first off, on what Brent has focused in his presentations on peak gold and peak gold exploration. We're well beyond the peak in gold exploration, and we're actually, by most analyses, by most experts, we've actually reached peak gold this year, and that production, for as long as it lasts, production is dropping here on out for a number of years in the gold market. So that's going to have a big effect on it. But you also mentioned the upcoming New Orleans conference, and coincidentally, I was rummaging through our storage unit here at Jefferson Financial last week in our archives of our audio-video archives of the New Orleans conference, and I ran across a VHS tape of your speech in 1993. Now, I haven't found the VHS player yet to see what you said, but I'm intrigued by the title, which was 10 Baggers, Stocks That Could Appreciate by 1,000%. I know that your compliance officers, now that you've gotten so big and powerful in the industry, would not allow you to have a title like that again. And in fact, I may have written that title back then. 25 years ago for this speech for you. But I think that those stocks that you mentioned in that presentation very likely did just that, or a substantial number of them did. That was a great time to be investing. And I think investors in this sector need to have a sense of timing, that, when the market is turning, these exploration stocks offer that kind of potential.
Well, it's funny that you hearken back to 1993. Funny in many senses. I hope your viewers don't look at that tape and see what I looked like when I had hair. It's also interesting that 1993 was the beginning of the last really hot exploration cycle that we had. You'll remember that there were a couple of discoveries that sparked that market.
Right.
One was Arequipa, which went from 35 cents to $30 in 19 months, if my memory serves me well. And the other was, of course, the great diamond discoveries in northern Canada, the Diavik and the Akati the discoveries. As I recall, the big diamond discovery, and I even forget the name of the company, was a sort of a 50 cent to $140 move in that period of time. When people have gone through, as we have, a 4 or 5 year bear market where the index itself has declined by 90%, they forget the reason why they have traditionally taken risks over time. And a discovery cycle that coincides with an underlying strong market for commodities is one of the most exciting financial events that takes place. In fact, there's a statistical work that's been done on this. There's an old investment tome, and I forget the author, but it's 100 to 1 stocks, and it examines the way that the circumstances that occur behind stocks that go 100 to 1. That's not 100%, that's 100-fold.
Right.
And one of the things it talks about is leveraged commodity producers during a commodity bull market off of a very depressed cyclical bottom. And I think it's interesting to recall that when people are so depressed coming out of a cyclical bottom as we are. The truth is, Brian, you've observed this, these bear markets are the authors of bull markets, and I think the concurrence of a commodity bull market and an exploration bull market it's just a very exciting prospect.
Yeah, and that book you're talking about obviously referenced marginal producers that are barely break even at a certain commodity price, and when the commodity goes up, their profits explode. But there's also these companies that don't produce anything, that barely explore, if at all, when these kinds of manias hit. I remember looking back during that diamond bull market and getting the daily price quotes from the Canadian markets through the old Canadian quote fax that would come across the fax machine, and I saved some of those over the years just as to illustrate how these markets work. But in that diamond mania, there were companies that literally moose pasture, did not have anything but a square of ground in some amidst millions and millions of hectares of unexplored territory that was potentially prospective for diamonds, and they were trading for $3 and $4 a share. And it's just an example of what these manias can do.
Well, I certainly hope that that sort of mania that you discuss won't return. It's bad for the industry, and it's bad for the speculators who get caught up in the mania. It's important in terms of exploration, speculation success. If you hope to keep any of the money that you made by accident, that you focus on really, really, really strong management teams, A players. I think that's important for everybody to know. Don't count on getting swept up with the tide. get involved in the tide on a lifeboat that has a very, very, very good skipper. I'm reminded of the great Buffett quote, which I'll paraphrase, which goes to the fact that there are millions of folks in the world who can play basketball, but you win games with a couple of 7-footers. And it's important to know in the exploration business that there are some serially successful 7-footers. And I want to compliment you, Brian. The New Orleans conference in the last 30 years has had a really spectacular population of these 7-footers. The Bob Quartermains, the Ross Beatties, the Robert Friedlands of the world. And it's important to note that commodity prices and a general exploration market by itself don't give you a great risk-reward parameter. But if you merge those two with high-quality, serially successful people, then the game begins to tilt decidedly in your favor.
Yeah, and it's a matter of this understanding the timing and where you are in the market. And as we said, I think we're in a good place in that respect, in the timing aspect and being able to get in some of these plays early. But it's also a factor of educating yourself. And of course, the New Orleans Conference has proven to be a great place to do that. All of those big winners that you mentioned were introduced at our event at very early stages in their lifespan. So our attendees were able to reap those kinds of profits. But it's very important in this sector to educate yourself. I was just putting out wrote one of our pre-e-letters, Golden Opportunities letters today, where I stressed that I think there's probably a half dozen newsletters out there right now that I'd recommend that I think are real in this industry. And there's probably less number of conferences. Your event in the summer has become one of the go-to events. I think the New Orleans Conference has been one of those go-to events for decades now. And there are a few others out there where you can go talk to some of the better analysts, better newsletter writers, but importantly, meet the management teams face-to-face and ask them the tough questions. And you've done that for years at our event, educating our attendees on what those questions should be. What do you say to a company? One of the best things you've told our attendees over the years is to ask a company, what do you do when things go wrong? What's your plan B? What if this doesn't happen? In probably the majority of cases, that's exactly what happens. They have to go to a plan B or C.
Well, and beyond that, it's important that your subscribers understand that probably 80% of the listings worldwide are valueless, completely valueless. Mm-hmm. That studying the sector is important because although the sector can really perform, probably 60% of the total sector performance, that is positive performance, is generated by 5% of the companies. It isn't distributed well across the 2,000 public companies that litter the investment landscape and pretend to be in the exploration business. Having the ability to differentiate in movie parlance between the good, the bad, and the ugly is absolutely critical. And I think you perform a real service for investors, both with your newsletter and for your conference, in sort of pre-screening, so that people have a curated list to choose from, which I think is important.
Well, we are looking forward to having you this year at the conference, and along with a few dozen other top experts in the sector.
Right. Well, I'll just add too that even though the world of information has changed and people are not getting their prices on the fax machine like Brian used to get, I know personally that going and meeting people in person gives much more value. That it's much more relatable. You remember it better. I met you at the 2010 conference, and so I've been part of that process. The written text we see in so many of these articles is not personable. People don't relate to it. So that's why I recommend going in person as well. Any other thoughts, Brian? Or
well, I think that coming to the conference, you actually get to meet. I can never promise our attendees that they'll be able to meet a Charles Krauthammer or Dennis Gartman, but they usually are. They usually can. You run into these guys in the hallway, and you have really meaningful conversations with them. And You can ask them pertinent questions and get answers, sometimes the kinds of answers they'll never say on television. And of course, Rick, I call Rick the hardest working man in show business, because he is at his booth when the exhibit hall opens and when it closes, and he is just always available to attendees to talk about the markets and strategies. And there's nobody better out there to talk to educate you on this market than Rick Rule. So we're very excited, Rick, to have you back again. And thank you so much for your thoughts today. Valuable as always.
Pleasure. And I guarantee your attendees will be able to meet me. I'll be right in the booth, looking forward to facing traffic.
Excellent, Rick. Thanks so much for your time.
Good. Thank you, gentlemen.
Thanks, Rick.